The Absa Property Equity Fund aims to offer investors medium to long-term capital and income growth through investments in the South African property market, listed shares and property unit trusts. The fund currently has 17 property holdings. In studio to share their investment strategy, Mariette Warner, Portfolio Manager at Absa Asset Management. Mariette, we've had on balance, would you say it's been a depressing show? Or
I think it's generally been depressing.
Generally a depressing show. So we're hoping that you are going to lift the mood this Monday night so that we can bear to come through for the rest of the week.
Well, given the recent performance or year-to-date performance of the listed property sector, yes, we can all cheer up. It has been
the problem is that most people haven't been invested.
Exactly. And that's one of the questions. Why have they not been invested?
The problem is it's had such a strong run for 10 years. The question is always posed, is it a bubble? When is it going to turn? And it's not a simple asset class. It might be small within the whole JSE. It's only 3% of the all-share index. But it follows an equity-type cycle, being the earnings, which is GDP-driven, with a lag because of lease expiry profiles, and it's very interest rate sensitive.
Do you think that in general people invest in property too much for the capital gain and less so for the income? And do you think the investor would be better off just focusing on the income earning capability of property?
I think what you've said is exactly right. Because of the big run recently, the expectations are for more like equity type returns. Now those days are over. I mean, yields are low, that more liquid stocks are trading on very fine yields, that they're actually tracking the short end of the yield curve, more like money market rates. And that's not sustainable. It creates volatility. So really the way I try and position the fund is you have your core of long-term earnings growth, because if you look over the longer term, say the last 5 years, the real earnings growth from a basket of shares, you can then track their price performance, and through all of this volatility, they continuously pull ahead. So yes, the focus should be on growing income over time. That's what listed property is there for, as an alternative to cash and bonds.
All right, now, but if you do look at the performance, and it has done incredibly well for the last 10 years, of course, that sustainability question comes to the fore. Can it continue to repeat this performance?
It can't do to the same extent. Returns are definitely going to be more moderate, and you cannot have the expectation that capital value will continue to climb the way it has. It has run out of steam because the yields have become too low. What is going to drive it going forward is the earnings growth over time, and I cannot emphasize that enough. I mean, I believe that these funds should target investors who are income sensitive, who want income growth, a yield in excess of inflation, plus growth at least matching inflation.
So what sort of income is you've got 17 shares within, or 17 stocks within the portfolio. The mix of that, what sort of income is that generating?
The average is around 7% initial, and then growing at an average of 5% going forward. Maybe a bit less next year, depending on what happens with the strength of the economy. So that is what you can expect if your core focus is those that can generate income growth in an economy which is not that strong.
But obviously the overall sector has done way better than that, and in a sense it's a problem for the sector, because the sector, because it's given you both the income and the capital return, it's done so well that it's drawn in a lot of investors who are now attracted by this idea of the capital return. And if at any point the capital is not there, then you run the risk that a whole lot of investors run away, and you get this massive underperformance. So it remains, for me, that perpetual risk. Investors need to invest in this for income.
Just reiterating, is that a significant risk in your book?
It is. I mean, if you look at the good performance today, it really has been driven by the yields coming right down, people pushing capital values up before results even have come out, and you don't even know what the income growth has been over the past 6 months. It has not yet been reported. Prospects for the next 12 months have not been commented on. So it's an expectation driving the values up and up. And it is up and down because there are investors who actually see this. But what I think is going to happen during the balance of this year is that expectation is going to be muted, and you're going to see those investors who want the capital growth will realize it's not going to be the extent that they were hoping for, and then you will see exit from largely the more liquid ones, which have given the strong growth year to date.
And so, Mariette, let's talk about the hotspots in the listed property environment. What are you exposed to right now, and what should we be exposed to? Or what should Kevin be exposed to?
Well, in terms of my fund, as I said, I've got this core of solid performers who are going to survive the slight economic weakness. And then you have to be astute in terms of relative pricing and some arbitrage opportunities. So the fund doesn't look the way it did on the April fact sheet. I've made some fairly big changes. I've gone underweight those who've run very strongly. With some I've exited completely, and others where the yields are still in excess of 9 or almost 9, and they've been laggards. That yield gap has to close between 9 and 6. Not entirely, I don't believe, but certainly there are some that have got a lot of legs relative to the ones who have performed this year to date.
All right, now we want to know which ones have got a lot of legs.
I can't tell you that, otherwise I give away my competitive advantage.
I was trying my luck. Of course I've got to try.
If we drill down into the sectors, though, so let's look at industrial, office and shopping centres. Yes. Have you got a preference within that? Is your portfolio evenly balanced across the sectors, or is it skewed towards maybe shopping centres and more industrial and away from office?
In a weaker economy, it's always more skewed towards regional shopping centres. They definitely outperform when the economy isn't great because of their dominant nature and their own economic base makes sense. At the moment, the weaker sector, as we've been reading for the past years, the office market, especially the B grades. But how low can those vacancies go? And I think with some of them we've reached a point where the vacancies have stabilized. They're not falling, but they will eventually. You're getting that high yield on a huge vacancy. I mean, there's got to be a cyclical shift. It's not going to happen very soon.
But isn't that only going to happen when the demand, or when the supply of A-grade office space is over, if you can say?
The pricing is too different. So B grade is much more price sensitive than A grade. For something like iconic green building, brand new, high spec, the tenants are not that rent sensitive. There are other issues that are more important. In the B grade market, an office is an office is an office. So that is very price sensitive.
Is A grade not coming down though, with pressure?
Not the top level, no, not the top level, because there has not been that much overbuilding, not at all. What we are seeing is the weaker businesses are either failing or reducing the size requirements in the B-grade office market.
If we switch over to retail, you said regional retail, so kind of the bigger shopping centres are doing quite well. Let me ask you this question, is South Africa overtraded in terms of retail offering? If you looked at Johannesburg, there seems to be kind of a new retail centre almost.
You're referring to Nickel Way, the one that just popped up.
Suddenly there's a new centre.
A huge big centre.
Is it a little bit overtraded, or are we okay still?
We are largely okay still. Now, what happens with this overtrading story, I don't believe we are overtraded in terms of the big regional offering. You just can't get the sites and the zoning or the tenants, the nationals, if it's in too close proximity. Where there is pressure is the more secondary, the second tier, especially those centres that are older, and management has pretty much been sitting on their hands too much for the last 5 to 10 years. And then the sharper guys come in and they create a new centre down the road. It's too close by, but because the older offering is just no longer that appealing, everybody flocks to the newer offering, which does perfectly fine, leaving the older one a bit in the doldrums.
Some anecdotal evidence in the Nickel Way, recently visiting.
That is the most
parking. All you've got to do is assess the parking situation. You cannot find a parking place in Nickel Way for love or money, and just down the road you've got Pick and Pay on Nickel. Also, the parking is incredibly difficult to find. So the consumer's there. I don't know if my anecdotal evidence is what you're seeing.
But in the terms of something like Nickel Way, you must always remember there is the new factor. Everybody wants to go and see the new thing. So it takes up to 6 months, I would say, to see how sustainable that interest is going to be.
And then there's fatigue.
It takes a while for fatigue to set in.
In terms of industrial space, what are you seeing in terms of vacancy? Are you more looking at warehouse type space? Is it very much focused on the big infrastructure hubs around airports? Is that the more sort of attractive area?
It's very much about visibility on highways, because the top level of industrial is distribution and logistics. I mean, the manufacturing industry, I don't have to tell you, that is in no great shape. So that part of the industrial market is very weak. What is strong is that more modern facilities, and by modern, 5 to 10 years is not that old. And new supply is difficult because of electricity, for instance. There's no more space on the grid. The land is there, but if you can't get the services in, it's not worth anything.
How big a factor is this lack of serviced land to property development around South Africa?
It's a big factor.
Is it literally that people are wanting to develop and finding that there's nothing being approved, or is it that some areas are developing better than others?
On the industrial side, it definitely is. There is demand for new modern space, but the services, that is a problem. That is constraining that particular sector.
Are you satisfied?
No, one more question.
You've got about 20 seconds to ask the question and get the answer.
Because of that lack of serviced land, are you finding that rentals are moving up within the industrial space?
It's not moving up so much as vacancies are staying close to zero. The economy isn't strong enough for those rentals to go up, but they're not going backwards. That's the difference.